Have you ever wondered how central banks control the amount of money in the economy? Who decides how much money is too much or too little? Well, in today's episode, we'll break it down from the Central Bank of Nigeria, how they manage Naira, and how the US Federal Reserve control dollar. Stay tuned because understanding this key is also to understanding how inflation, interest rate, and even your personal finances actually interplay. The central bank is like the money referee of the economy, and the job is simply to keep prices stable, ensure banks behave responsibly, and make sure there's just the right amount of money circulating. Too much money means that prices will rise. Why? Because people now have excess money chasing the few goods that they have, and then that will drive up prices, leading to inflation. Too little money also simply means that people don't have enough money to do their businesses, and that will slow down business. And then, of course, unemployment will grow because enterprises will start slowing down. So how does this control balance out? Let's dive in. Now, the first method of actually measuring or actually controlling the amount of money in circulation is the use of open market operations, or simply put, you can call it OMO, open market operations. This simply means that the central bank buys and sells government securities like the treasury bills or the bond. When it buys securities, it injects money into the economy, that is more liquidity or more spending. When this happens, what it means that people now have money, and then economic situations actually drives up. But again, the implication is that people now have enough liquidity to chase the goods. When it sells security, on the other hand, it pulls money out of the economy. That's like tightening the economy. And the implication is that people now keep their monies with the bank, and then they don't have enough money to do businesses. And then that will slow down the rate at which they purchase the goods and services. If inflation is rising, what should the central bank of any country do? Like the US Fed Bank, what should they do? They simply just sell bond. When they sell bond, it is to reduce cash in circulation, and the essence is actually to cool down the demand. Now, the second method actually is what we call reserve requirement. What's the reserve requirement? Reserve requirement is the portion of customers' deposit that the bank is expected to actually keep with any central bank. Meaning, if a customer keeps 100 naira, how much of this 100 naira is required statutorily to be kept with the central bank? And that is what we call the reserve requirement. If the central bank increases reserve requirement or reserve ratio from, say, 10% to, let's say, about 15%, what it means that the banks now have less money to lend, and that reduces the money in circulation. And when that reduces, lowering the ratio does the opposite, more lending and then more money. And then the third one is interest rate policy. Now, how does this work? Now, the policy on interest rates is simply called the monetary policy rate, right? In the US, if it's federal funds rate, when the rate rises, borrowing becomes more expensive. Banks lend less, money supply shrinks. When the rate falls, loan becomes cheaper, spending increases, and the economy grows faster. An example of this is in inflation. If inflation hits a double digit, the central bank might raise the MPR to discourage excessive borrowing and then stabilize prices. Thank you for this part one. I'll be dropping the part two and how this actually interplay with exchange rate in our next video. Thank you for watching, and see you in the next video.